Hey everyone, it's Alissa Coram back with another IBD Live clip for you, featuring Mike Webster, former IBD head market strategist. Now, Mike worked many years directly alongside IBD founder Bill O'Neil, and he developed a grading system for stocks and setups. And he walked us through what that looks like using Palantir as a recent example. Take a look.
When you're deciding what stocks to buy, you don't want to, they're not all created equal. Right. So you want to have a priority list, because let's say you're in a market where you've got 20 or 30 stocks that are set up. You want to be able to say, okay, this is the one, and they all break out at the same time. Which one are you going to buy? You probably can't buy all of them. So you have to have a priority on there. So I would rate, I've always rated stocks. I used to do it 1 to 10, and I changed it to A through F back when we started doing the master's program, and I was teaching it to people because people can relate to A to F a little bit better. And so when I look at a stock, I look at every stock and I rate it as an A to begin with. And then I look at things on it to decide where to move that, to lower it or to raise it back up. And I like to have a kind of a set way of doing it. But how this ties in with Bill, and then we'll get into going over Palantir, is that when I would do my Sunday calls with him, which probably did for about a decade and a half, and we would go every Sunday, I would basically research all day, and then I'd have my list of stocks to talk to him about, and I'd have my A stocks that I talked to him about first, then my B stocks, and then I always have a group of C stocks. So I rarely would talk to him about those, but that would also help give me a gauge of the market environment. So if I had a bunch of A stocks and B stocks, that was telling me that there was a good environment. If I only had C stocks, that was a different, kind of a different situation with the market. And as it turned out, what we kind of backed into, that when there were only C stocks for a few weeks, that was pretty much the market was going to start rolling over, and it did. And so if you do this on a regular basis, and I think everyone should do this on the weekend and talk to somebody about it, set up a Zoom call with your buddies, or do it on Twitter, or do it however you want, where on a weekly basis, even if it's a horrible bear market or it's a raging bull or anything in between, that you're just doing it every single week and you're bouncing ideas off of each other. You're going to learn a lot, and it's going to create an accountability that, like I had when I was having to talk to him with names. So when we go over things, we'd start off with the monthly chart first, always with the monthly. So let's go there. And with that, it would tell you kind of what you were dealing with. And so obviously, Marusha, what is this that we're dealing with? Like, if this is the only thing how would you rate this, good or bad?
It would probably not be great. It'd be in between.
Yeah, right.
It's coming off. It's showing some strength, but it needs time.
Yeah. So forget about the name. Forget about the CEO being, really super charismatic. I like the dude, and the AI and all that stuff. But you're just right now. What we're doing is we're just focusing in on what happened. So it had this big move up, and then it fell apart, and now it's got this powerful bounce up. So that moves it from an A down to a C. Like, this has not done anything. It wasn't able to hold its original move. Now, of course, there's context. There was a general market, was horrible and everything, but it's also a $15 stock. And then Bill really did not like cheap stocks. I mean, the higher the better. There was a time when he wanted this one. I don't know if he told Chris, but he was telling me that he wanted a news section in the newspaper. Maybe we did it. I don't remember. We did, but of just the highest price stocks. Did you guys end up doing that?
No, but I remember him talking about that.
Yeah. So you talked him out of it, I guess.
He did have the data monitor.
Yeah, I think I created that one for him for a while, and maybe you took that over. But yeah, that was his kick, was the highest price stocks, and he was right, which Bill's always right. So anyways, so we start off with an A. It's a $15 stock. It's had a rocky time. So we're going to bump it down to like a C at this point. Now we'll go over to the weekly chart. And we won't do every last thing on here, but I would start over on the left side and I'd go through all of that data and be looking for things that were defective. Because especially if I was going to mention something to Bill, you know, I wanted to make sure it wasn't defective, or if it was defective, that there was something that balanced it on the other side. So he was really, you know, one of the many things that he came up with was this kind of teeter-totter thing, that it was one or the other. So the classic one was return on equity above 17 or a high pre-tax or after-tax margin. And he was that way with a lot of different things. So we've got a return on equity of 6%, which is problematic. The PE is high, but he wouldn't care about that. He would focus in on in that area, the composite rating, which is something we could talk about in a little bit. I mean, doesn't get better than 99. 88 was his cutoff point for that. So remind me later, if we have time, we could talk about the composite rating. So at this point, because we've got a high composite rating, we've got in the earnings, the annual earnings, we've got increases 8 to 13, but then down to 6. That's a huge red flag. He would want at least 3 years, and the more the better, of increasing annual earnings. Because if you go back to Can Slim, right, is you've got your current earnings and your annual earnings, and 3 years of annual earnings increasing was huge. If there was a defect there, it was a big deal for him. So that 6 cents for 2022 is problematic. But then strong estimates for 23, huge estimates actually, and strong for 24. So that kind of counterbalances it a little bit, is that teeter-totter. But still, with what we're looking at, I'm saying it would be about a B at this point. Excuse me. Then we'd move down. One of the other things that we would always do is go and look at other big stocks in the group. So his idea of having the top RS stocks in there, you always want to look at every single one, because the worst thing I could ever do was recommend like Palantir to Bill and then him say, well, what about IoT? Isn't that better? And not having looked at that one. So you want to look at all of them, and then that also helps you when you're grading, because then you're grading apples to apples, the stocks that are in the same group. So we'll go back to Palantir for a second, but we would have theoretically gone through all of those top ones. Then we're going to go down into the quarterly block, and we've got the nice acceleration from -75 up to 150, which is really constructive. But what's the problem with the sales? Arusha, I got to keep you awake. What's the problem with the sales?
Decelerating.
You're just trading your. We have a show.
I'm not
There are
trading
a lot
without
of people
observing.
that I really want to know what you think about these sales.
No,
They're going down.
they're starting to decelerate, especially from the 49% to 18.
Yeah,
so
they're doing the
that's
Freddie
not a
King
great
thing.
trend.
They're going down. We don't like that, right? So it's going down on a regular basis. So it's not a one-off. So that is a problem. So now I'm still saying that that's a, you know, based on all of this, I'm just kind of doing the mosaic, that without looking at the chart, we're at like a C. Right now we go over to the chart and we're like, wow.
Except, super quick, fund sponsorship. How does that impact the rating?
I don't look at that. Look,
Okay.
Bill, we would spend a ton of time on sponsorship, ton of time. In fact, we would go from the monthly chart to sponsorship. But the way he taught me how to use sponsorship, it wasn't the number of funds. That was something that you used to do way back when, you know, the increasing of funds, that dropped off a long time ago. But it was what funds were in there and what were those funds doing. So he had his favorite funds, right? That, you know, were essentially in the IBD Mutual Fund Index. If there weren't some of his favorite ones in there, there would have to be some other high performing funds. So one of the things that people probably overlook the most, that he spent the most time on, was looking at the ownership. And you don't have to know hundreds of mutual funds. Just get to know 10 or 15 funds and ones that trade our style in general, growth stocks, and that have had, they don't have to have great performance. They just have to have enough capital that they're going to be pushing these stocks up and they have good performance. And then see if they've been adding to them or not. So we would look at it, and he had some funds that he really disliked. I won't say their name, but he had some fund families in there that weren't clients of William O'Neil, that he really had studied and thought that they really didn't know what they were doing. And so if they were in there, that was a big negative for him, especially if they were adding to it. But if his favorite funds, like a Contra fund of Fidelity, was in there and adding to it in a big way, that carried a ton of weight, way more than a lot of the specifics on the chart. Because the concept was, these guys and girls of the big funds, they have access to the management. They go visit the companies. They have the companies come out and pitch them, so they know everything backwards and forwards. We're just looking at a few numbers on here, looking at the company's website, what have you. But we don't really get that same thing that they get. So from Bill's mind, and I totally agree, is you've got these really smart, well-educated analysts who are meeting with the companies. You've got, successful PMs who are then taking that information and deciding what to do. Is what are they really doing with their money? Are they in there buying the stock, and then are the type that are going to keep buying? So sponsorship is huge. But now going back to the chart, we look at this and goes, okay, well, this is kind of like a high tide flag. And we know that those are rare, where you get a big move up in a short period of time, and then you hold most of that. So it's in the flag portion of it. And if you go back and you study the flags are actually deeper than you would think. I would go back and look at Taser, obviously Bethlehem Steel from, a little over 100 years ago. And the flag portion of it, so you have this flagpole where it runs up. So I wouldn't get hung up on the percentages. You want this powerful move that's saying the stock is having, something is different. Maybe a big fund or two has come in there. Or with this, I think it's just, all of a sudden everyone discovered AI, like it hasn't been there, but now everyone discovered it. And so anything with AI is just moving. So you've got this company that has a big move up, and then it doesn't give it back. It's holding in there, and that's relatively tight for it. So it's forming this flag, the flagpole, and then the flag. And then the flag should be really contained within, 25, 28% or so. But it's more proportionate. You want to look at it and say, did that hold most of those gains? And in spirit, regardless of what the numbers turn out to be, it's a high type flag. So then that bumps it up, right? Because a high type flag we know is rare. Everyone's always looking for it. And so now it went from a C, started at an A, went down to a C, was in a B range, and now we're at like an A minus because of the flag portion of it. I wouldn't say it was an A minus down at the base at 10.
Yeah.
I mean, if you bought it down there, great, good for you. I wish I had, I didn't. You're a stud or a stud-S, but I'm just a dude who missed it. So let's go to the daily chart real quick. So now you study the flag portion of it. You see right away it's not obeying the 21-day, which is your green line. So that's good to know, because some stocks obey them, like the one that Chris was trading came right down, almost touched it, and then bounced. This one undercut it. So you just got to realize people who trade use the 21-day, aren't supporting it here. It's a little bit underneath it. So that's good information, but that break off the peak was a little rough. And then, that big downside reversal. So you have some clear profit takers in there. And so that's concerning. Like, I don't like the way that flag is forming. So I wouldn't normally I'd use an alternative pivot within a flag. And I don't see an alternative pivot in here. It's just like this V-shaped thing that's come down. So I don't see a buy point. So now that's gone back down to a B, you know? And so the point is, when you're rating a stock, you're moving it up and down based on the information, fundamental and technical and sponsorship, and deciding, you know, how big of a deal it is. And when you get an A or an A plus stock, you want to try to hold on to that, and you want to try to build as big of a position as possible. The internet, just wrapping this all back up. So what everyone should do every weekend is go through and rate a bunch of stocks, have their A's, B's, and C's, and then find a forum to share it with other people that you respect. And then you'll learn that way. It was very intimidating doing those Sunday calls with Bill. At first, it was extremely intimidating, but it forced me to learn a lot. So try to find someone that intimidates you and share it, and then have them be, you know, give aggressive pushback.
Well, I hope you enjoyed that clip, everyone. I have a couple more featuring Mike Webster that I'll be rolling out over the next couple of weeks. So make sure you subscribe to my channel so you can stay up to date on all the latest whenever I launch a new video. Thanks so much, and see you next time.